Hey everyone, it's Amanras and let's be real. Who doesn't want to make smarter trades? We all want those green days, right? Today we're diving deep into the world of candlestick charts, one of the most powerful tools in a trader's arsenal. Think of this video as your one-stop shop to go from candlestick newbie to chart ninja. We'll break down everything from what those little lines and boxes actually mean to how you can use them to spot trends and potentially make some serious cash. Whether you're just starting out or have been trading for a while, understanding candlestick patterns can give you a major edge in the market. So, grab your notebooks, buckle up, and let's get started on the road to trading success. Welcome to our guide on mastering candlestick patterns for trading success. Today we'll break down the essentials of candlestick charts and how you can use them to make informed trading decisions. You know, I remember when I first started trading, it was like staring at a foreign language. All those lines and charts just looked like gibberish. But let me tell you, once I cracked the code of candlestick patterns, it completely changed my trading game. Suddenly, I could see the market from a whole new perspective. It's like having X-ray vision into the minds of other traders. So, what exactly are candlestick charts? Well, they're basically a visual representation of price action over a specific period of time. Each candlestick tells a story, revealing the battle between buyers and sellers in the market. By learning to read these stories, you can gain valuable insights into market sentiment and make more informed trading decisions. Trust me, once you get the hang of candlestick patterns, you'll wonder how you ever traded without them. All right, let's break down the anatomy of a candlestick. Don't worry, it's not as intimidating as it might seem. First off, you've got the body of the candlestick. This is the big rectangle in the middle, and it tells you the opening and closing prices for that specific time period. A green or white body, that's a good thing. It means the price closed higher than it opened, signaling bullish sentiment. On the flip side, a red or black body means the price closed lower than it opened, indicating bearish sentiment. Now, sticking out from the top and bottom of the body, you'll see these thin lines. These are called wicks or shadows, and they represent the highest and lowest prices reached during that time period. Think of them as the tails of the price action. See, not so complicated, right? Understanding these basic components is key to unlocking the secrets hidden within candlestick patterns. The body of the candlestick is crucial because it shows the strength of the price movement. A long body indicates strong buying or selling pressure, while a short body suggests indecision or a lack of momentum. By analyzing the body, traders can gauge the market sentiment and make informed decisions. For instance, a long green body after a series of red bodies might signal a potential reversal. So, always pay close attention to the body of the candlestick. It holds valuable insights into the market's behavior. The real body of a candlestick can vary in length, and this variation is significant. A long body indicates a strong price movement, either up or down, showing that buyers or sellers were in control. Conversely, a short body suggests that there was little price movement, indicating indecision in the market. For example, a doji candlestick, which has a very short body, often signals a potential reversal or a period of consolidation. Another example is the hammer candlestick, which has a small body at the top of the range and a long lower wick, indicating that buyers push the price back up after a significant drop. By understanding these different types of candlestick bodies, you can better interpret market trends and make more informed trading decisions. Let's talk about color coding, because in the world of candlesticks, color is key. We already touched on this briefly, but it's worth emphasizing. Green candles, or sometimes white candles depending on the chart settings, are your friends. They represent bullish momentum, meaning buyers are in control and pushing prices higher. Think of it like this: green for growth, green for gains. On the other hand, red candles, or sometimes black candles, signal bearish momentum. This means sellers are in charge and prices are heading south. Red can mean caution, a time to potentially hold back or even short the market. Now remember, a single candlestick doesn't tell the whole story. It's all about patterns and context. But understanding the color coding is like knowing the basic grammar of candlestick language. Chapter 4. Single candlestick patterns. Quick insights, powerful signals. Now, let's dive into some actual candlestick patterns, starting with single candlestick patterns. These are patterns formed by just one candlestick, and they can offer valuable insights into market sentiment. One common pattern is the doji. This candlestick looks like a plus sign or a cross, with the opening and closing prices being very close together or even equal. The doji is a sign of indecision in the market. It's like buyers and sellers are in a standoff, unsure of which direction to take the price. Then you've got the hammer, a bullish reversal pattern that typically appears at the bottom of a downtrend. It's characterized by a small body at the top and a long lower wick, indicating that sellers tried to push the price down, but buyers stepped in and drove it back up. On the flip side, the shooting star is a bearish reversal pattern found at the top of an uptrend. It looks like an inverted hammer, with a small body at the bottom and a long upper wick. Chapter 5. Double the candlesticks, double the insights, mastering dual patterns. Moving on to dual candlestick patterns, these are formed by two consecutive candlesticks and can provide even stronger signals about potential market reversals. One powerful pattern is the bullish engulfing pattern. Imagine this. You have a small red candlestick followed by a large green candlestick that completely engulfs the previous candle's body. This signals a potential reversal of a downtrend as buyers have stepped in with force, overwhelming the sellers. Conversely, the bearish engulfing pattern is the opposite. It involves a small green candlestick followed by a large red candlestick that engulfs the previous candle's body. This suggests a potential reversal of an uptrend as sellers have taken control and pushed prices down. Keep in mind, context is everything. Don't just rely on these patterns in isolation. Look for confirmation from other indicators and the overall market trend. Chapter 6. Triple candlestick patterns. Confirmation is key. All right, let's level up our candlestick game even further with triple candlestick patterns. As the name suggests, these patterns involve 3 consecutive candlesticks and often provide more reliable signals, especially when confirmed by other indicators. First up, we have the morning star. It's a bullish reversal pattern that typically appears at the bottom of a downtrend. The pattern consists of a long red candlestick followed by a small-bodied candlestick, either red or green, and then a long green candlestick that closes above the midpoint of the first candlestick. It signals that the selling pressure is weakening and buyers are starting to take control. Then there's the evening star, the bearish counterpart to the morning star. It occurs at the top of an uptrend and consists of a long green candlestick, a small-bodied candlestick, and a long red candlestick that closes below the midpoint of the first candlestick. And let's not forget about the 3 black crows and 3 white soldiers patterns. These are strong trend continuation patterns. 3 black crows consist of 3 consecutive long-bodied red candlesticks, indicating a strong downtrend. Conversely, 3 white soldiers consist of 3 consecutive long-bodied green candlesticks, signaling a strong uptrend. Now that we've covered some key candlestick patterns, let's talk about why they're so important for traders. First and foremost, candlestick patterns help you identify trends in the market. By recognizing bullish or bearish patterns, you can get a sense of whether the market is likely to move up or down. This is crucial for making informed trading decisions. But it's not just about identifying trends. Candlestick patterns can also help you time your trades more effectively. By spotting potential reversal patterns, you can enter trades at more favorable prices and potentially maximize your profits. And let's not forget about risk management. Candlestick patterns can provide visual clues about the strength of a trend, helping you set appropriate stop-loss levels to protect your capital. Now, before you go all in on candlestick patterns, let's talk about some tips for using them effectively. Remember, candlesticks are just one tool in your trading toolbox. It's crucial to combine them with other indicators for confirmation. Don't just rely on candlesticks in isolation. Look for confluence from other indicators like moving averages, the relative strength index, RSI, and volume. When multiple indicators align, it strengthens the signal and increases your chances of a successful trade. And here's a crucial point. Always analyze candlestick patterns in the context of the broader market trend. A bullish reversal pattern at the bottom of a downtrend is much more significant than one that occurs during a sideways or choppy market. Context is everything. Finally, practice makes perfect. The more you study and analyze candlestick patterns in different time frames and market conditions, the better you'll become at interpreting their signals and making profitable trades. So, there you have it, guys. We've covered a lot of ground today, from the basics of candlestick anatomy to some advanced triple candlestick patterns. Remember, mastering candlestick charts takes time and dedication. Don't get discouraged if you don't become a candlestick pro overnight. Just like anything worthwhile, it requires practice, patience, and a willingness to learn from your mistakes. But trust me, the rewards are well worth the effort. By incorporating candlestick analysis into your trading strategy, you can gain a significant edge in the market and potentially boost your profits. So keep studying, keep practicing, and never stop learning. The world of trading is constantly evolving, and those who adapt and stay ahead of the curve are the ones who succeed. So there you have it, a crash course on candlestick charts and how they can take your trading to the next level. Remember, knowledge is power. And the more you understand about the markets, the better equipped you'll be to navigate them successfully. If you found this video helpful, hit that like button and subscribe to my channel for more trading tips and insights. And don't forget to share this video with your fellow traders who could benefit from this knowledge. Let me know if you'd like more details or visuals for any section. I'm always here to help you on your journey to trading success. Until next time, happy trading.